All right, what is up, everyone? Very excited to bring this video to you today. This is going to be one of the most important videos I think that you guys need to watch this year, okay? Specifically because we're at the end of the year and you need to know what's going on so you can truly prepare for the end of the year heading into 2025. Now, this is the strongest year-to-date gain through 3 quarters for the S&P 500 since 1997. We're going to break down exactly why that is from a fundamental, from a technical standpoint. So you're going to learn a lot in today's video. Be sure to smash that like button. Subscribe to the channel if you guys are new. Help me get to that 10K subscribers goal. By the end of the year, we're almost there. Just need about 900 more subscribers. Now, one of the reasons is because bear markets and corrections have been less frequent since the 1990s. We'll explore this some more. Bull markets have also been longer since the 1990s. And when you combine that information together and you take a look at how major market turning points typically happen with each generation's peak, and you see that we hit our generation's peak of Gen X and we had a strong decline, we'll dive into that some more. It really suggests that we're heading towards continuation in the cyclical bull market. Now, there's data to back this up. Okay. When you take a look, we're hitting new cycle highs in the NYSE weekly new highs, new lows index. We've also got the NYSE advanced decline line hitting new all-time highs. And it's not just NVIDIA. Okay. We're going to break down the actual data showing you guys the contributors to the S&P 500's year-to-date price return. We've got 32% of stocks in the S&P 500 playing catch up currently. All right. And NVIDIA did drive the market in the first half. But as we just described, that's not what we're seeing in the second half of the market. The average stock is performing better in the second half of the year, and the distribution of year-to-date returns really shows and exemplifies this. So we're going to break down all of this data in today's video. Now, even while this is happening, the semis percentage of total S&P 500 net income is hitting new highs. And this is coming as we're getting market breadth and market participation. Take a look at these ETFs right here. Okay, we're talking about the airlines via jets. We're talking about ARK-K. We're talking about consumer discretionary, the IPO ETF, materials and mining's ETF, and then the S&P and the NASDAQ 100. You look at all of these and you take a look at their performance since the August 8th lows. We're seeing double-digit returns in all of these, okay? That is not screaming that we're about to head into a massive bear market, all right? Take a look at the equal weight S&P 500 hitting new all-time highs, right? Breaking out from its multi-year base right here. Very beautiful. We've got record utilities inflows, right? We've got PE ratios at the beginning of the Fed easing cycles for 2024, the highest PE at the start of a Fed cutting cycle in over 60 years, right? And we'll talk about the Fed cut versus the economic cycle, all right? We'll talk about how 55% of CPI came back to pre-pandemic levels, and we'll talk about the current election cycle that we're in right now and how it compares historically via the other election cycles. Okay. Then we'll dive into small caps a little bit. We'll talk about the Russell 2000 rolling 5-year annualized return. We'll talk about the biggest weightings and the difference between the S&P 500 and the Russell 2000. This is going to be good and important for you small cap investors looking to find those small cap market cap gems. We'll talk about the Russell 2000 median EPS growth and how it's faster growing than the S&P 500. And then we'll talk about since 2010, how buying the 10% dip has been a very successful strategy. Meanwhile, we've got money market funds continuing to hit all-time highs and increasing $126 billion since the Fed's first rate cut. Absolutely amazing. And we'll talk about the possibility from Tom Lee here about how technology becomes 50% of the S&P 500 weight in the future. We've even got a quote here from Mark Zandi, who's not necessarily known for being accurate historically, but basically just describing the economy and how everything right now is good. Okay. And things can change in the future, but for right now, there's a lot of things that are good that he points out. We'll go over those. We'll talk about GDP. All right. Get into some GDP things and we'll talk about GDP some more, revisiting some of the revisions that we had in 2022. But as always, the content provided on this channel is for informational and educational purposes only, and it's not intended to be, meant as legal, financial, or investment advice. Okay, so be sure to read through the disclaimer. All right. Now, if you're new to the channel, I did start a completely free newsletter for you guys. It's called Investment Intelligence. I give out free, valuable, and finance trading related content. All right. And I even try to sprinkle in some free trade ideas in there for you as well. So you guys can go back and read the newsletter. All right. There's a website associated with it and just read some of the previous articles, right? See if it's something that you guys would like sent directly to your email inbox, right? It's kind of a blog format. Now you can join the Investment Intelligence private trading group using promo code Powell. That is where I'm posting all of the trades, all of the stocks, everything that I'm looking at, and even just thinking about, right? And putting my thoughts in there. I'm not as active on YouTube these days. And that's just because, YouTube is just, it's never been my thing, right? I've been trying to put out YouTube videos to put actually good content because I felt like there was a lack of good content on YouTube. But I'm very active in the Discord. You guys can find me in there every single day. Now, inside of there, over 20 plus swing trade ideas every week. There's custom scripts and indicators, exclusive intel, exclusive chart layouts, right? And take a look at some of these returns, guys. All right, these are very big returns. Now, I do trade options, so these are not going to be your typical returns that you would get. But I love trading options, and I'm posting all of my trade ideas in there. So whenever you see, these type of results, you guys know already ahead of time what it is that I'm looking at, what my trade ideas are, and what things I'm interested in. Now, I did launch two new products here recently, the Pulse Radar, which is a short-term swing trade list anywhere from 1 to 30 days. All right. These are some of the results, right? This is a good example of PCG. All right. We talked about this one. The original post was on August 11th. We spoke about the inverse head and shoulders, how we reclaimed the anchor VWAP from the 52-week highs, and how this was a good setup above that anchor VWAP for long positions. And that's when the stock was around 1820. Now, the stock ended up going up well over $20, smashing through all of the bullish price targets that we had above. And you can see the short dated call options went well over 1000%. And even the longer dated call options went up well over 200%. Now, there's also the zone finder. Okay. So there's different things for different type of traders. Okay. The Pulse Radar is for 1 to 30-day swing traders. The zone finder is people looking for actionable trade ideas that are going to have results. You're either going to get stopped out or you're going to get nice profits less than a week, right? Less than a trading week. So these anywhere can be from intraday. Like recently, last week, I traded NEM, Newmont, got 100 over 100% on a single day on call options, took those profits, right? Now, sometimes it takes a little bit longer. Sometimes it may take anywhere from 1 to 5 days. So the zone finder is for your very short-term trader, okay, looking for those gains. And the Pulse Radar is for also your short-term swing trader, but who has a little bit more patience, right? Who can wait 1 to 30 days. I know there's different type of traders who have different type of expectations. And I developed these two products just for you guys. Okay. Now, I did debut the first initial trade idea from the Zone Finder in the Investment Intelligence newsletter. That was on BMY. This is Bristol Myers. And this was the setup here with the falling wedge. And very shortly afterwards, the call options went up extremely high. So, subscribe to that newsletter. If you don't want to pay for anything, that's fine. Subscribe to the newsletter. I'm going to put out good content in the newsletter. I don't try to just put out BS. All right. That's my promise to you guys. Now, let's go ahead and get into the juice of the video. This is the strongest year-to-date gain through 3 quarters. We're up over 20.8% for the S&P 500 since 1997. Now, Zach, how can this be? How is this even possible? This doesn't make sense. Well, let's dive into it, okay? Bear markets and corrections have been less frequent since the 1980s. Now, I know this may look like a barcode, okay? And you might be asking, what's on sale? It's not Prime Day yet, right? What we're looking at is 20% drawdowns in orange. So let's just focus on that. Bear markets, right? A 20% drawdown is your bear market. This is 1928 over here, guys. Take a look at the duration of the orange bars here, right? We can see that they start off large and they get smaller, and they continuously get smaller, right? Look at the two we just had recently. Those are some of the two smallest bars that we've had. Okay, this is big. This is a big deal. All right. And it really just emphasizes, how much American companies and the US economy has grown, evolved, and adapted. Okay. At the end of the day, the companies that you're investing in now have learned from literally 100 years of business. Okay. They've seen different economic cycles. They have these things to study for. And businesses these days take that information, okay, and use it. They don't just leave it on the sidelines, don't ignore it. They look at this data because they know they have shareholders they're responsible for who are going to bring up this data. They're going to take a look at their free cash flow. They're going to take a look at their earnings. They're going to take a look at their margins, and really see what their expenditures are like, where's the cost, and they have all these things to answer for. And US companies in particular have really just adapted to be, where we live in a capitalist market, right? In a capitalist society. And we've really gotten good at that. We continue to improve on that. And it's most likely that in the future, in the next 100 years, we're going to continue to improve on that. Okay, so this is 1928 right here, roughly 100 years to 2024. All right, let's just call it 100 years. We're emphasizing the 20% drawdowns here. Look at how big they were in the beginning and look at how small they are now. In the future, if we're going to continue on this same type of path, these drawdowns, they're always going to be present, right? There's always going to be risks in the market, but companies are getting better and better. And it's possible that we continue to see this trend where these 20% drawdowns continue to get shorter and shorter. All right. That's just what this chart is emphasizing. Now, on top of that, the exact opposite. Bull markets have been longer since the 1990s, right? We take a look at bull markets here, right? The years since the last 20% drawdown is going to be your dark blue here. The years since the last 10% drawdown is going to be your light blue here. And what do we see? We see that on average, these are all much larger than what they were in the past before the 1990s. Again, really just emphasizing that the U.S. economy, the best companies in the S&P 500 in the U.S. economy are continuing to improve and they're just getting better at business. It's just that simple, right? So if you're someone who really thinks that the end of the world is coming and that all businesses are going to tank, then maybe this information isn't for you. Maybe you really are truly a perma bear. But historically, it's just been in your favor to be bullish over the long term, right? That doesn't mean we can't have a 20% correction in the next year. Doesn't mean we can't have a 50% correction in the year. But when you really look at the things, and I've shown the data, you start looking over 10 years, you pretty much always have a positive return in the S&P 500 over 10 years. And the reason being is because these are the best 500. These are the top 500 companies in the world, in the US economy, which is the greatest country in the world. And they just continue to improve decade after decade after decade. And most likely that trend is going to continue. Now, major markets turning points, all right, typically happen with each generation's peak. Now, the millennial peak is not until 2038. All right. Recently, we had the Gen X peak, which was around 2018. And what did we see? A 20% decline. Now, if you go back in past, you will see that each decline has been greater, right? The boomer peak in 1999 led to a 30% decline. The silent generation peak in 1974 led to a 35% decline, and the greatest generation peak in 1930 led to an 89% decline. Keep in mind what I just went over about how bear markets have gotten shorter over the last 100 years. Okay. And the drawdowns as a result have also gotten shorter with each generational peak. Now, this doesn't mean that this is going to continue to be the trend forever. Okay. It's very possible that this Gen X peak, maybe we haven't seen the max drawdown. Maybe it's going to draw down more. All right. That is a possibility. And it's possible that the millennial peak in 2038 could see over a 30%, over a 35, or over an 80% decline. Those are all valid possibilities. But when we just keep in mind the facts that we just went over the last two previous slides, the future, there are a lot of things to be optimistic about in the future. Now, going through data for today, right? We went over a lot of really large and old historical data. Let's just take a look at the facts of the today. right? We have the NYSE composite making new all-time highs, right? This is your New York Stock Exchange Composite Index. And then we've got also got new cycle highs in the weekly highs versus new lows in the New York Stock Exchange. This is bullish, right? There's nothing more bullish than price going up, right? And more stocks making new highs versus new lows, right? That's the definition of a bullish trend, and that's what we're in right here. Okay. Now, this isn't a short-term video saying that we're going to continue going up over the next day, week, or month, but this is more of a long-term perspective video to show you guys we're in a very healthy, very strong bull market right now, and nothing is suggesting that this bull market is over at the moment. Now, more evidence. You take a look at the New York Stock Exchange advanced decline line. We're hitting new all-time highs in the New York Stock Exchange advanced decline line. Again, this is the number of stocks advancing versus declining, right? This is something that I posted in the Discord a while back ago, right? And when you see that data, whenever you see the New York Stock Exchange advanced decline line hitting new all-time highs, it's very rare that the S&P 500 does not make new all-time highs shortly afterwards if it's not already making new all-time highs. Okay, so that's something you want to keep in mind. Now, a lot of people in the first quarter, second quarter, the first half of the year, they were very, very adamant on the fact that it was all NVIDIA, and not just NVIDIA, but really just the mega cap tech stocks. That's not the case. Okay. If we take a look right now to the contributors, all right, through September 23rd of the S&P 500 year-to-date price return, NVIDIA only accounted for 3.9% of the S&P 500's total 19.6 return. Meanwhile, the other 495 stocks accounted for 11.5%. At this specific time, you had Meta at 1.2, Apple at 1.1, Amazon at 1, and Microsoft at 0.9. So, you combine five of, some of the biggest market cap stocks in there, and we see that the other 495 actually accounted for more of the S&P 500 gains than just those. Okay, so that narrative has really died off in the second half of the year, and we're now in Q4. In the second half of the year, we've seen 32% of stocks in the S&P 500 playing catch up. Okay. Over 32% of stocks playing catch up. They were negative in the first half, and they're now delivering positive returns in the second half of the year. This is big. Okay. This is a big result. And this is that catch up trade that a lot of people like me were talking about in the summer, right? When we were pointing out the bullish setup on the RSP, the equal weight S&P 500. That was one of the main things that I was emphasizing. And if you've been a newsletter reader, I even put articles out about that. That, hey, look, we're getting a lot of signals that the equal weight is about to outperform the market cap weighted. What does that mean? Well, that means that the highest mega cap stocks, with the largest market caps, maybe those stocks are going to cool off a little bit, and maybe we see the rest of the market catch up. And that's exactly what we're seeing. NVIDIA did drive the market in the first half of the year. When the S&P 500 only had 14.5% gains, NVIDIA accounted for 4.4% of the S&P's 14.5% gain in the first half of the year. Meanwhile, the other 495 stocks only accounted for 5.7%. That's basically a 1% difference, right? NVIDIA basically outperformed the market, or only underperformed the other 495 stocks in the market by 1%. Okay. That is a very big deal when you talk about contributors to the S&P 500 year-to-date price return. And again, that's not what we're seeing currently. The landscape has changed in the second half. Now, we just started Q4. Keep that in mind. We just started Q4. So things could change again, and we could see tech really start to lead the way now that we've seen a lot of these other stocks catch up, quote unquote. Now, the average stock is performing better in the second half of the year. The first half average for the average stock in the S&P 500 was 5.4%, and in the second half, we're at 8.4% returns for the average stock in the S&P 500. And when you take a look at the distribution of year-to-date returns, right, you've got a small number of stocks, right, down here in that lower percentile, right, -80 to -60, -60 to -40. You can see that there's basically about 20 stocks that are -20 to -80%. And then when you take a look at this, you've got about 15 stocks that are rallying 60% or higher in the S&P 500. Meanwhile, the bulk of those, okay, are right here in the middle of that -20 to 0% all the way up to 60%. This is where your bulk accumulation of stocks are when you take a look at the number of stocks within the year-to-date return bucket. Now, as this is happening, okay, as this is currently happening, semiconductors, their percent of total S&P 500 net income is still hitting new highs. So easy, even as we've seen, Nvidia not necessarily carry the gains of the market in the second half of the year so far. Their percentage of total net income is still hitting new highs in the semiconductors. So again, just because we're seeing this shift in trend right now, this could be something that lasts a while. It could be something that lasts through the next quarter or maybe the next couple of quarters. Or you have to keep in mind the possibility, and something like this chart right here really shows it well for you, that these semiconductor stocks and these AI related stocks really could start to, replicate some of the gains that they saw in the first half of the year. That is a possibility, and that is something you have to keep in mind. And a chart like this shows you a valid reason why, right? What's the valid reason why? Well, it's because their net income as a percentage of S&P 500 net income is hitting new all-time highs, right? And continuing to rise, even though those stocks are cooling off while the other stocks are catching up. So do keep that in mind. And right here, what we've got, okay, to lead us here. And basically what we're looking at is the August 8th lows, right? Those were some very important lows in the market. Since then, what have we seen? Well, we've seen the JETS ETF up 23%, right? What is the JETS ETF? That's your airline ETF. We've also got ARK-K. ARK-K is those innovation stocks, right? Cathie Wood is known, she used to be known years ago for making lots of people lots of money, right? She saw very exponential gains, huge, massive gains in her ETF. And since then, it's been absolutely terrible, right? And people have been ragging on her, trashing her. Those stocks are working right now. Okay. This is again just to emphasize that catch up trade thing. This is all healthy, right? We're not seeing one of the bears' biggest arguments the whole first half of the year was that, hey, listen, everything's going to fall apart as soon as the Mag 7 stop performing. What have we seen? The exact opposite. We've seen the market continue to make new all-time highs, and we're seeing the other stocks besides the Mag 7 really catch up while the Mag 7 have been moving sideways or underperforming, pulling back during these recent, over the last quarter. Again, we talked about JETS and ARK-K. XLY, consumer discretionary stocks. Okay. We've got the IPO ETF. All right. Coming in here at fourth place. We've got XME. This is metals and miners ETF. Okay. Gold has been hitting new all-time highs right now. We've got the NASDAQ and the S&P 500 both up double digits since the August 8th lows. Nothing about this is screaming bearishness, right? It would be different if all of these ETFs were negative. If all of these ETFs were negative and only Nvidia and the Mag 7 stocks and big tech and mega cap tech was rallying right now, then you could have a case and you could continue that bearish case that the bears had in the beginning of the year, first half of the year, saying that, hey, listen, this is scary. It's only big tech. What happens if big tech starts to fall? And we've seen that the other parts of the market have picked up. Okay. Now this could possibly be a rotation play. Okay. It could just be money rotating out from those stocks into some of the other sectors that have lower PE ratios that maybe are more attractive on a valuation standpoint, or it could just be simply some of that money on the sidelines, right? Everyone keeps talking about the money on the sidelines. We'll talk about the massive amount of money in money market flows here shortly. But let's just take a look at the RSP, right? And I've gone over the bullish setup a few times in the videos that we've gone over it in the Discord. I mean, look, this is a multi-year base right here coming into a bull flag, bull pennant, resolution right here that what happened, we know these are continuation patterns. What was the trend heading into it? It was a bullish trend. We continued up to the upside. Things look good in the market right now. This is an equal weight S&P 500 hitting new all-time highs last week. Okay. Now we've got record utility inflows. A lot of people are going to tell you that this is bearish, okay? But when we look at charts like this, when we go over the data that we've been going in the data, this is not necessarily bearish, okay? There's actually, believe it or not, this may sound like bubble trouble to some people, but utilities are now being considered an AI play, okay? And I'm not here to push the AI narrative on anyone. I'm simply describing what's happening in the market so you can understand. Utility companies, why would they be driving the AI play? Well, this is going to take massive amounts of energy. Okay. And energy is a whole different subject when we talk about things like natural gas or crude oil or heating oil or gasoline. Okay. I've done some posts in the Discord about that. And we've seen a very, very strong rebound in energy ever since I highlighted that. Once again, we were ahead of the curve. I've got a video coming down on energy specifically, but it's more of electricity. Okay. You're going to need massive amounts of electricity, which is going to result in massive amounts of energy to power all of these AI infrastructures. Okay. When you talk about the clouds, when you talk about the data sources and the data networks, and just the AI chips powering all of this AI technology, it's going to require massive amounts of electricity and energy. Okay. And people are realizing that. They're like, hey, you know what? Maybe we don't have to dive into AMD at this current price evaluation, right? What about the stocks? Everyone talks about the picks and the shovels, okay? How with the gold miners, it wasn't the people, it was all the people selling the pickaxes, okay, who made the money, right? That was the way to get rich. And so people initially looked at that and said, oh, well, if AI is the play, why don't we just get rich off of the companies that provide the chips that make the AI work? Now people are diving further into it and they're saying, well, who's going to provide all these chips? What do the chips need, right? Well, the chips need all this electricity, right? They need all of this energy. And so now you're seeing a lot of that money flow into utilities, and we're seeing record flows in utilities. Guys, you don't see record flows like this at a top. Okay. And that's just it. All right. Whether you like it or not, this is very, very bullish. Okay. Doesn't mean that some of these areas of the market can cool down where you're seeing these record inflows. Yeah, you're not going to continue. It's very unlikely that you're not going to continue to see record inflows and inflows and inflows week after week, week after week, week after week. But this just shows you the sentiment, right? And this just shows you where hedge funds, where institutions, where big money is putting their money at, right? Where are they paying attention to? It's in utilities, right? It's not just AI anymore. When it comes to when we say it's not just AI, it's not just seven stocks, okay? It's not just seven stocks. I've talked about this before in the past, but look at companies like Caterpillar, look at companies like John Deere. You think these machines, these industrial grade machinery companies aren't going to benefit from AI? You mean to tell me that if these people can sell forklifts that don't need an operator anymore, that companies aren't going to pay more for those or be willing to pay a monthly prescription, for AI data software that can operate the machinery cheaper than, a forklift driver, for instance? And that's just forklifts, right? We're not even talking about the real big heavy duty machinery that a lot of these companies make most of their margins and profits off of. Okay. Now, PE ratios at the beginning of Fed easing cycles. When you take a look at 2024, it has the highest PE at the start of a Fed cutting cycle in 60 years. Now, there's two ways you can look at this. Okay. We're going to talk about the bearish narrative first. Oftentimes, the Fed cut precedes a bear market. All right. This has happened multiple times, right? You look at the dot-com bubble, you look at the great financial crisis. The Fed started a cutting cycle and we went into a bear market. So there is that valid point. Right now, all I would say to the bears is, hey, are we at a place right now in time where you think that the AI bubble is as big as the dot-com bubble? And for to go over that, you have to take a look at PE charts, okay, and take a look at some of the price to sales ratios, price to earnings ratios of some of those big dot-com bubble stocks, and take a look at the current price to sale and price to earning ratios of the current AI quote unquote bubble stocks right now. And you'll see there's a massive difference. NVIDIA has actually gotten cheaper on a valuation standpoint from price to earnings versus something like Cisco, right? So I'll leave it at that for the bearish narrative. For the bullish narrative, this just suggests that, hey, we're in a Fed easing policy. One of the biggest phrases and well-known phrases is don't fight the Fed. Right now, valuations are high, and we're in a Fed, easing cycle right now where we're getting stimulus, okay, via Fed rate cuts and other things like that. And this suggests that, hey, even though valuations could be a little frothy right now, it's very possible that they could go higher with the Fed rate cut, policy that we've got before us. Now, again, Tom Lee from Fundstrat highlights this here. Don't fight the Fed. When you take a look at the Fed cut versus the economic cycle, we're right here currently, which is that Fed cut plus no landing. Okay. So it's very different when you have a Fed cut plus a recession. But when you take a look at the Fed cut plus no landing, the data looks a lot different. All right. 3 to 6 months out, 100% of the time, we are positive. This is the biggest data set right now, especially if you're a shorter term investor. Okay. Again, past results don't indicate future returns and future results, but 100% of the time, 3 months forward and 6 months forward, the average S&P 500 returns have been 8.4 and 12.8%, right? Now, when you look at 12 months forward, again, 100% returns, and we're looking at 15.8%. That's currently the landscape that we're in right now. Now, this can change at any time, and we could head into a recession. It's very possible. The labor market does look concerning. Unemployment, when it typically curves the way it's curving and spikes the way it's spiking, oftentimes that does lead to a runoff in unemployment and an explosion in unemployment, and typically that leads to a recession. I've already made those videos and covered those things. I want to point out new data to you guys, which is why you need to subscribe, because I'm going to present you guys with all of the good data and give you my interpretations on it. And then ultimately, you guys will have somewhere that's non-biased, right? When there's bullish data, I'm going to present you the bullish data. When there's bearish data, I'm going to present you that bearish data. So help me get to that 10K subscriber mark. Now, what's another bullish backdrop here currently at the moment with the Fed cutting and, with the Fed easing cycle that we're in right now? Well, 55% of CPI came back to pre-pandemic levels. Okay, so this is not your normal CPI chart. Okay, as you actually see this chart going up, this is good, right? The higher, the better, the lower, the worse. All right, and you can see in September 2022, we kind of bottomed out around here. Remember, the bear market ended in October of 2022, and the stock market returns have looked kind of similar to this CPI chart right here. Again, basically what we're looking at is 55% of CPI came back to pre-pandemic levels. This is a bullish tailwind for the equities markets. Now, here we've got the election cycle versus the current S&P 500. So the current S&P 500 is going to be here in red. And then you've got your different type of election cycles and all of the other colors here. Now, trend is more important than the level. And what do we mean by that? Well, simply what we mean is that just because we were rallying so hard in red here, early off in the period, it doesn't mean that we're due for a correction. It's more about the overall trend. And the trend in the previous cycles was higher here, right? And you see we had these dips in the beginning and we continue to rally higher. That's basically what we're seeing right now, where we typically have these dips. And right now we're actually continuing higher. So seasonality is something that I emphasize a lot, right? And I put a lot of importance on because I've seen personally over the past 3 years now, 2022, 2023, and 2024, that seasonality does play a big part in the market. But it's not something you're going to make all of your investment decisions on. What's more important is being able to look back and say, hey, were we respecting seasonality? And if we are, can we perhaps use that to our leverage in the future versus, hey, I'm going to predict what the market's going to do based on seasonality. Now, what all do I mean by that? Again, you look at these periods here, and I'll tell you straight up, in the beginning of the year, there were some gains that I missed out on in February and March because I looked at seasonality and I said, hey, we typically peak in February and March and have a decline heading into April. And what did we see? We did not see that at all. Okay. And as I mentioned, seasonality is pretty big for me. And this was a learning curve, right? Everybody makes mistakes. And when you try to use these things to predict the market, they can sometimes bite you. And you take a look at where we're at right now. We're in this period here where the market's supposed to be going lower. I mean, we just had the yen financial crisis, or we just had the Japanese yen carry trade blow up, right? We just had the VIX hit some of the highest levels we've seen in forever. Okay. And still the S&P 500 is continuing to make new all-time highs. So that just tells you, hey, maybe you don't want to bet necessarily on us pulling back, right? Maybe if we do end up, putting some type of bottom towards in the later October period as we head towards that election and get closer to the election results, it's very typical for us to get some type of a pullback before then. But that doesn't mean that I'm out here looking to short the market just because seasonality says that we typically have a pullback. Okay. And that's the way that I want you guys to think about it too, is hey, maybe you're not looking to short everything, but maybe you're not as aggressive right now. Maybe you're looking for where are the opportunities in case we have some type of election pullback. That way, when November comes, you can see, hey, did we actually put in some type of bottom related to the election? If we did, right? And as I mentioned, you want to look at this and look back at these in the past and see if we're following seasonality. Okay. Because if we do put some type of bottom in close to November, in the beginning of November or late October, then that suggests, when you look at all election years, that we're going to have a strong rally into the year end. Okay. And so that's how I'll be interpreting this election data coming forward as we get closer to the election. Now, let's talk about small caps a little bit. We've got the Russell 2000 and S&P 500 rolling 5-year annualized return. Russell 2000 will be in dark blue. We're just going to focus on that. All right. And what I want to show you guys is the compounded annual growth. Okay, the CAGR, the compound annual growth rate is less than the S&P 500 growth rate. We are at the worst levels that we've seen since 2000. Now, what does this suggest? Well, it suggests that things are really bad in small caps and are going to continue to be really bad in small caps. Or if you think that this Fed rate cut policy is going to be a tailwind, a bullish tailwind for small caps, it means that this could be a potential buying opportunity. And this is something that Tom Lee has been emphasizing. This is from Fundstrat, which is Tom Lee's, company, that he runs. And again, this is, if you're more of a bull, this suggests that, hey, there's a lot of catch up left still in the small caps and in the Russell 2000, and this could lead to an outperformance in the Russell 2000. Now, when you look at the sector weightings of the S&P 500 versus the Russell, only 24% of the S&P 500 is composed of financials, real estate, industrials, and biotech. But in the Russell 2000, almost 50% of it is composed of financials and real estate, industrials, and biotech. So if you're someone who thinks that, the Russell 2000 is going to outperform, these are some areas that you may want to look into, right? Obviously, information technology is always going to be some, technology stocks. There's always tech stocks, that can have these really amazing runs and do really amazing returns. But I wanted to point out with the not so obvious, right? Where do you actually want to be looking at? Well, I think it's in one of those three areas of this pie chart right here: the biotech, the industrials, and the financials and real estate. When you take a look at small cap industrials, I showed this, I've shown this in the Discord before. The small cap industrials index looks amazing. Okay, it's been looking amazing. Small cap financials are looking good. There's lots of different areas in the market that may not seem so obvious where you can potentially find outsized returns in the future. And this chart really suggests that, right? When you look at EPS growth, EPS is earnings per share. Small caps earnings per share is faster growing versus the S&P 500. When you take a look, we've got 18.7% versus 11.4. Now, small cap earnings per share is faster growing at every quintile, whether it's the first, second, third, fourth, or fifth quintiles. Every single quintile, the Russell 2000 is faster growing at every single quintile. Now, we've seen some big dips in the market, okay? If you're someone who's been around over the past 2, 3 years, you've seen many, many dips. And since 2010, buying the 10% dip has been very, very successful, okay? Your average return, over a 1 month, 3 month, 6 month, 2 year, 5 year, all right, is going to be in this light blue right here, okay? So you can see over the 5 years, if you just, over the long term, when you look at these things, it really just stays, true to be invested into the market. Okay. I've shown the data over new all-time highs and how new all-times is bullish, right? There's nothing bearish about new all-time highs, but buying the dip is a very successful strategy on a 1 month, 3 month, 6 month, 12-month basis. So basically 1 month to a year, you typically outperform the market if you do buy those 10% dips versus the average return. Okay. Now, this is from Gunjan over at Wall Street Journal. Assets and money market funds have increased 126 billion since the Fed's jumbo size rate cut and hit a record 6.76 trillion Tuesday. Now, here's the obvious that's not obvious. You're getting cash in these money market funds, right? That's the whole purpose of it, right? Is you're getting that risk-free return. Do you actually think that people are withdrawing every single time they get money out of their money market funds? Are they actually just pulling that money out and pulling the returns that they get out? No, that money is compounding in there. So it only makes sense that this money is going to continue to go higher. Now we've seen this huge rapid spike here recently, um, you know, in the assets and money market funds. And why is that? Well, I covered in the beginning of the video that, hey, there have been several times where the Fed has cut rates and began a Fed rate cut policy, and the stock market has gone into a bear market. So, as much as people could be fearful that, hey, maybe I'm not going to get as great returns in my money market fund because the Fed is now cutting rates, and maybe those really high interest rates that I got are no longer there, they're also just so accustomed to saying, hey, well, this isn't money that I've been touching. This isn't money that I've been using to buy Nvidia. This isn't money that I've been using to pay for my bills. If the stock market is going to crash, why don't I just keep my money in that same risk-free area, right? In those money market funds. And so a lot of people, I think, are actually putting more money into there and saying, hey, I don't mind having some cash on the sidelines that's risk-free just in case we do fall. And why is a big result of that? Well, we've talked about the outperformance in the second half of the market, from the other 495 stocks in the stock market. Again, maybe people are rotating out of some of these mega cap tech stocks, some of these stocks that are up 80% or over 100% on year-to-date returns. Maybe they're taking some of those profits, guys. I mean, is that crazy for people to take profits on massive wins and stick it into money market funds at a time when you're unsure if these Fed rate cuts are going to lead to a recession and a bear market or if they're going to be a tailwind for the stock market? So, I mean, this isn't something that really should be surprising to me. This is a chart that continues to go up, and I think that you're going to continue to see it go up. You're going to continue to see money in money market funds continue to rise and assets and money market funds continue to rise because that money typically stays there, right? That's not necessarily typically money that people are using for bills and putting in there for 1 month and then withdrawing the money or putting the money in there for 2 months and then withdrawing. This is typically long-term cash on the sidelines, and that cash typically does tend to stay on the sidelines. Now, Tom Lee's got some stuff here about technology becoming 50% of the S&P 500's weighting. And he goes over how we're going to have a shortage of labor from 2015 to 2047. If you take a look at the past shortage of labors that we've had from 1991 to 1999, tech went parabolic, and the shortage of labor that we had in 1948 to 1967, tech went parabolic. Now, shortage of labor may sound kind of bearish, but technology tends to improve in that area. And specifically with all of the AI advancements that we're making, that's essentially his case here is that, hey, we could be in a shortage of labor that continues to last for a couple more decades. But AI technology is going to pick up that slack, right? And we've literally even got talks of robots now, guys, right? Robots are real. They may not be what they were in the Terminator movies that we saw growing up, but slowly they are possibly advancing in there, and everyone wonders if Nvidia is going to be Skynet, right? So at the end of the day, we'll have to see, but these are Tom Lee's predictions. He's someone who's been right, and he's been right because he's been bullish. He does very good data-driven work to be bullish. He doesn't just say, "Oh, I think the stock market's going to go up 10% because I'm bullish." He's always got some really good numbers and really good data to back that up, and he's been mostly right. So he's someone you got to respect at the end of the day. Now, Mark Zandi here. This is really interesting, okay? And we're going to talk about the economy a little bit more. But what he says here is that he's hesitated to say this at the risk of sounding hyperbolic, but with last week's big GDP revisions, there's no denying it. This is among the best performing economies in his 35 plus years as an economist. Economy growth is rip-roaring, with real GDP up 3% over the past year. Unemployment is low at near 4%, consistent with full employment. Inflation is fast closing in on the Fed's 2% target, with grocery prices, rents, and gas prices are flat to down over the past month more than a year. Households' financial obligations are light and set to get lighter with the Fed cutting rates. House prices have never been higher, and most homeowners have more equity in their homes than ever. Corporate profits are robust, and the stock market is hitting a record high on seemingly daily basis. Of course, there are blemishes as lower income households are struggling financially. There's a severe shortage of affordable homes, and the government is running large budget deficits, and things could change quickly. There are plenty of threats, which is always, right? There's always plenty of threats to the economy, but in his time as an economist, the economy has rarely looked better. So, not sure if that's him ringing the bell on the top. Mark Zandi, if you just do a little bit of research on him, does not have a great track record of predictions. He said similar things about the economy being great before the great financial crisis, things like that. But we won't dive too much into that. At the end of the day, all of this is just data and these are facts, and you have to take these facts how you see them, right? So these can either be, Goldilocks scenarios where everything's too good to be true and all of these risks, and threats are going to come to fruition, or that, hey, maybe, things are really good in the economy. If things slow down a little bit, it wouldn't be the end of the world or necessarily mean a recession. It could just mean, that we're thriving and booming right now, and a little bit of a return to normalization wouldn't be the end of the world before we potentially continue with a robust, thriving economy. Now, this is some of the numbers that he's talked about. GDP for the second quarter came in at 3%. All right, the Atlanta Fed's GDP estimate for the third quarter currently stands at 3.1%, and jobless claims are down at 218,000. It's very difficult to argue that the U.S. economy is slowing down. Now, Ben Castleman talks about remember the technical recession, which I remember at the time very specifically because they weren't calling a recession. But when I was looking up the terms of a technical recession, it was 2 quarters of negative GDP growth. And we had that in early 2022. Well, now all of a sudden turns out it never happened. We've got annual revisions now show output grew slightly in Q2 2022, and that growth coming out of the pandemic was faster than previously believed. This is one thing that a lot of people have problems with, myself included, is that a lot of the numbers always get revised much, much later in the future. So, who's to say perhaps that we aren't already in a recession or on the verge of a recession, and we don't find out about it a year later, or a year and a half, or 2 years later when they revise a lot of these numbers and say, oh, well, actually, we did have 2 consecutive negative quarters of GDP, right? So at the end of the day, being an economist, I don't think if you're an economist, you're out here watching these YouTube videos. And if you're watching videos like mine, you're just looking for good, reliable information. And that's what I'm trying to provide you guys with. Okay. So don't try to be an economist too much. I know personally people who were short the entire 2023 bull market, been short the entire 2024 bull market. And, it hasn't worked out well for them because they've been trying to be their own economist. Okay. I personally like to focus on technical analysis. I like to sprinkle in a little bit of seasonality, and then I also like to combine a lot of the data that I'm presenting to you guys in today's video when we go over historical returns. What are the current returns looking like? What are the current markets landscape look like? Things like that. Okay. Now, that'll wrap up today's video. If you really enjoyed it, I promise you guys are going to love the information and things that I go over in the Investment Intelligence Private Trading Group. Right now, you can join using promo code Powell. That will get you guys 50% off your first 2 months. Okay. What's inside? You'll at least get 20 plus swing trade ideas every single week. You're going to get all of my custom scripts and indicators. So whenever you see me in the Discord posting a day trade setup that I'm looking at, or posting a swing trade setup that I'm looking at, or some of the, more custom things like the zone finder or the pulse radar, you're going to have access to not only all of those charts, but also those indicators, right? And those scans to run them on your own, right? To use them on your own and have them on your own screen. So you don't always just have to rely on me, right? I'm here to provide what I'm looking at. But at the end of the day, all I'm trying to do is provide tools and resources that I've found useful to me, to other people. And I think that they can learn how to make them useful and beneficial to them as well. Okay, we talked about some of the outsized returns that I typically get, trading options. Options trading and these type of returns are not typical, but if you're a shares trader, right, and you don't have to be scared of options, right? These things and the things that I go over in the Discord and in my videos, they're not specifically only tailored for options trading, right? I'm not selling options trading to you guys. There's the Pulse Radar, okay? This is designed specifically as a tool for people looking for 1 to 30 day swing trades. Okay. So if you were some type of options trader, you would be looking at options that are 45 days out in expiration, to 90 days to however long, right? A minimum of 45 days. Okay. And again, here's some screenshots of one of the recent Pulse Radar trades. Okay. I should probably update this, and I'll try to update these in the videos. LVS is another really great one that we had in there. I know some people still holding on to call options right now that are up massively. And then we've got the zone finder. These are people looking for, very short-term trades, right? Anything from that can last as long as a day trade, and maybe you make money on your day trade and you just take your profits quickly. Two, sometimes they take a day, two, three, anywhere from one trading week or less, right? From a day trade to an entire trading week. And I post these all on the weekend so that you guys can prepare for them, look at them, and Monday you have your tools, you have your lists, and you know which ones are your favorites and which ones you're targeting. Okay. All of the links are in the description for all of those. Sign up for that newsletter. Okay. That's completely free. I'm not trying to shill too much on you guys at the end of the day. I'm just trying to provide value to you guys, because I feel like a lot of people online aren't providing true value. And so in the Investment Intelligence newsletter, you guys will get completely free value, going over free, valuable finance and trading related content. And in there, I do exhibit some really high quality trade ideas, right? That are actionable trade ideas, that you guys can dive into deeper, and look and determine if some of these things meet your own risk profile. There's a website associated with it. I promise you guys, check out that website. All right, read some of the previous articles. I've put out some bangers, okay? Some really, really good plays have come out over the past month or two, in that newsletter. And, people are making money off of these, right? We'll see if that continues to be the trend. I'm never going to promise you guys that I'm here to make you guys rich, or to make you $1 million or anything like that. But, I do try to be a real person and, provide you guys with real information. that's actually useful and is in, in investment grade level. Okay, type of analysis I'm doing. It's not just simple BS. These are really good chart setups that I'm highlighting for you guys. And once you understand, all of the things that we learn about and things that I go over in the community, you guys will really start to gain an edge in the market. Now, if you're someone who ever feels like, maybe this is all a little overwhelming for you, or hey, maybe you're a beginner, or maybe you've been trading around, but you have a lot of questions, right? I have a lot of people who come to me for options information, right? I want to go over option strategies and different things like that. You can always book a private coaching session by going to my Ko-Fi page. There's a link in the description for that. You click on the commissions tab, and in there, you can book a 30-minute or a 1 hour session. You can also click on this buy a coffee button, basically as a way to leave a tip or donation for all the free valuable content that I put out, such as these videos and the newsletter. Once again, I really appreciate you guys watching the video, especially if you made it this far. There's no reason you shouldn't hit that subscribe button. Really help me to get to that 10K goal that I'm trying to get of 10K subscribers. We're not very far away. Share the video with someone that you may think would be interested, and I'll see you all in the next one.